You might be surprised to learn there's a tax break specifically for legally blind individuals. And get this, it's been on the books since 1943. It's all about helping offset some of the unique costs that come with vision loss. But here's where it gets tricky. The federal government and states, like California, handle this in completely different ways. So we're going to untangle all of that for you. And this quote right here, it just hits the nail on the head. It's the whole reason this tax law even exists. I mean, the government gets it. There are extra expenses you might not even think about, right? Things like needing readers, guides, specialized equipment, or even just getting around. This tax break is basically a nod to those very real financial hurdles.
Okay, so this is probably the most important thing you need to get from this whole explainer. We're talking about two totally different systems. The feds, the IRS, they give you a deduction. Think of that as shrinking the amount of your income that gets taxed in the first place. But California, they give you a credit. A credit is like cash in your pocket. It's a dollar-for-dollar chop right off your final tax bill. Huge difference. Seriously, if you remember one thing, remember this.
All right, so let's get into the nitty-gritty. Here's our game plan. First, we'll nail down what legally blind actually means in the eyes of the IRS. Then we'll cover the single most important document you'll need, that doctor's letter. After that, we'll compare the federal and California rules side by side, and we'll wrap up with some smart strategies for when you actually file. Okay, Section 1. Let's define legally blind. Now, this is super important. We're not talking about a general idea of poor vision, or whether you can drive or read a book. No, the IRS has a super strict black and white clinical definition. It's all about the numbers, straight out of the Social Security Act. You either hit the mark or you don't. And get this, the timing is everything. Your eligibility for the entire tax year comes down to your vision on one specific day, December 31st, the last day of the year. It's kind of wild, right? Your vision could have been better all year, but if you meet the criteria on that final day, boom, you qualify for the whole year. So there are two ways to get there, two clinical gates you can pass through. The first one is all about visual acuity, and the fine print here is absolutely critical. We're talking about 2200 or less in your better eye, and this is key, while you're wearing your glasses or contacts. The second way is about your field of vision. If it's super narrow, just 20 degrees or less, that also gets you there. Let's focus on that first one, the 2200 number, because that's the one most people are familiar with. But what does it actually translate to in the real world?
Well, here's a really simple way to think about it. Imagine there's a sign down the road. A person with 20/20 vision can read it clearly from 200 feet away. But for you to read that same sign, you'd have to walk all the way up until you're just 20 feet away. That's what 2200 means. It really puts it into perspective, doesn't it?
All right, moving on to Section 2. So let's say you meet the definition. Now what? How do you prove it? Well, it all boils down to one single, incredibly important document, the letter from your doctor. Think of this as your golden ticket, your proof, your armor if the IRS ever comes knocking. So getting this letter isn't complicated, but you have to follow the steps. First, you got to see a qualified pro, an ophthalmologist or an optometrist. They need to write up a statement for you on their official letterhead. And it can't just be a vague note. It needs the hard data, the clinical numbers, like 2200 in the better eye. And here's a pro tip, a real game changer. If your condition is permanent, make sure they write that word, permanent, in the letter. It'll save you so much hassle down the road. And here's what that powerful language actually looks like. You see, a note that just says, John Doe is legally blind is, well, it's not good enough. You need the magic words. It has to spell out the clinical details, cannot see better than 2200, and then, there it is, the million-dollar phrase. The condition is permanent. That's the part that tells the IRS this isn't a temporary issue.
So, why are we so obsessed with this permanence clause? Because it's the difference between a yearly headache and a one-and-done solution. If your condition is temporary, say you have cataracts and are waiting for surgery, you have to go back to the doctor and get a new letter every single year. But if it's permanent, like glaucoma, and your letter says so, you get that letter once, you file it away safely, and you can reuse it indefinitely. It's a huge deal. Okay, Section 3. You've got your diagnosis, you've got your magic letter. Now let's talk about the payoff. How does this actually save you money on your federal taxes? We're diving into the additional standard deduction. I love this chart because it shows how this benefit literally stacks up. See, the IRS treats being over 65 and being legally blind as two separate things, which is great news. So for 2024, a single person starts with the standard base deduction, right? $14,600. Now, if you're 65 or older, you get to stack another $1,950 on top of that. And if you're legally blind, you stack another $1,950 on top. If you're both, Add them all up. Your deduction gets a whole lot bigger.
Now, let me clear up a really common misconception right now. This is super important. This extra deduction, it is not for a dependent. So you can't claim it for your child if they're blind. This benefit is only for the taxpayer or their spouse if they're filing jointly. Just for you.
All right, let's totally switch gears. I want you to take everything we just talked about with deductions and just put it on a shelf for a second. Because now we're heading to California, and trust me, they play by a completely different rule book. This table lays it all out so clearly. Look at the contrasts. Federal gives you that deduction that lowers your income. California gives you a flat $149 credit, straight off your tax bill. The feds don't care how much you make, but in California, if you're a high-income earner, that credit starts to disappear. But look at that third row, the proof. The IRS says, just keep the letter in your files. California says, nope, you have to attach it to your return the first time. And that creates a problem. Which brings us to the obvious question, right? It's the 21st century. Pretty much everyone e-files. So how in the world are you supposed to attach a physical doctor's letter to a digital tax return? You can't just tape it to your monitor. Okay, so here's the official, slightly old-school workaround. Your tax software probably can't handle this. So what you do is you print out your doctor's letter. You also print out something called Form FTB 8453. That's just your e-filing signature form. You physically staple the letter to that form and you keep it for your own records. The good news? You only have to do this whole routine the first year you claim the credit. It basically proves you did your due diligence if California's tax board ever asks to see. And that brings us to our final section, strategy. We've got all the pieces of the puzzle. Now, how do you put them together to make the absolute best choice for your tax situation? At the end of the day, it really boils down to one big choice on your federal return. Are you going to take the standard deduction or are you going to itemize? You can't do both. If you take the standard deduction, that's how you get that extra blindness bonus we talked about. For most people, that's the way to go. But if you have a ton of other deductions like huge medical bills or high state taxes, itemizing might save you more money overall. The catch is, if you itemize, you forfeit that extra blindness deduction. It's a trade-off, so you really have to do the math. Okay, let's wrap this all up with the key takeaways. First, to qualify, you've got to meet that strict clinical definition, 2200 vision or the 20-degree visual field. Second, your doctor's letter is your golden ticket, especially if it has that permanence clause. On the federal side, you get a cool add-on to your standard deduction. In California, it's a dollar-for-dollar credit with that quirky attach-it-the-first-year rule. And finally, the big strategy call. You have to choose between taking the standard deduction or itemizing your expenses. So I want to leave you with this final thought. This law, the one we've been talking about, was written way back in 1943. Think about that. That was long before smartphones, screen readers, GPS, all the technology that can dramatically change how a person with vision loss navigates the world. So the question is, as technology continues to evolve, does a strict numbers-based definition from the 1940s still make sense? Should the law evolve too? It's definitely something worth considering.